Do you live in a place where houses are very expensive? If so, it can feel really hard to succeed as a real estate investor. But I know many investors who over time, like in 10 years, did even better and made even more money because they started in a place with high prices. So in this video, I want to share one story, a case study about a couple who begins in a high-priced market with $80,000 and grows that to $1.4 million. And they did this by using smart investing strategies that you can use too. Let's get started. I want to give you a little bit of background information on this couple in the story. They live in Oakland, California, which in the Bay Area of California is definitely a high-priced real estate market. And each of them work a full-time job, and together they make $300,000 per year. And over the last couple of years, maybe they got inspired by some friends who were talking about it. Maybe they saw my YouTube channel. Maybe they read my book, The Small and Mighty Real Estate Investor, or something sparked their interest in real estate investing. And they said, you know what? I know the first step we have to do is at least save up some cash. So this is no easy feat. You know, you're living your life, you have to save a little bit of money, you got to save that extra bonus, you have to spend a little bit less, but they're able to save up $80,000 to get started with something. Now, that's always the question, right? Like there's a fork in the road here. What should they do? Could they go invest long distance and maybe buy properties in a separate market? Because currently they live in a rental property in the Oakland area. So they don't own their own home. So they could just keep on renting, buy another property in another market, maybe in Ohio or South Carolina or Texas or somewhere else. Or they could also invest that money locally, but it's expensive. The properties are expensive. So I want to go through a plan that if they were sitting down one-on-one with me, there's no right perfect answer here, but what if they decided to invest locally? How could they do that? And I want to go through a 10-year plan of what that might look like. So the first step I would recommend if you're investing in a high price market, the hard part is just getting in to get that first deal. So one of my favorite strategies is something called a house hack. Now, if you haven't heard of a house hack, it basically means you live in a property that you can also rent out part of that same property. And there's a lot of different ways to do this. You could just live in a single family house. And if you wanted to, rent out extra bedrooms. Some people feel comfortable doing that. A little bit more private way to do this is to buy a duplex, which is one building, one roof, but it has two different apartments in that one building. Another variation is to buy a single family house and have a granny flat or what's called an accessory dwelling unit in the backyard. And then you rent out the ADU, or maybe you live in the ADU and rent out the house if you want to make even more money from that. The point is you buy a property, and instead of buying just a house that you live in and you don't generate any income from it, sort of a hybrid investment. You live in it and you rent it out. And the benefit is that you're able to get some income from that rental to help you make your mortgage payment. So it makes it more affordable. In the best case scenario, I've even seen people pay 100% of their mortgage payment. I did that in the case when I started doing house hacking. But in a high price market, even saving half or a quarter or a third of your total cost of housing can help you just get into a property and make it more affordable. So that's what this couple did. They bought a house hack. They moved into one side. And another huge benefit of this, if you're trying to get in a high price market, is there's owner occupant financing or mortgages that you're able to get with smaller down payments. Because if you were to go buy an investment property just right off the bat, you typically have to put 20 to 30% down on a property. So if you're buying an $800,000 or $1 million property, a 20% down payment could be $200,000. 30% is $300,000. So that's way more than this couple has. But if they move into the property, there are loans out there like FHA, which stands for Federal Housing Administration loan of 3.5% down. If they're veterans, they might be able to get a 0% down loan through the Veterans Administration, or even conventional normal mortgages. There's 5 and 10% down loan programs. So even on a $1 million property, they found a $1 million duplex. Maybe they could get in for $50,000 down, 5% down, have a little bit extra money to help fix it up, do some closing costs. So it's feasible. It's possible. They could just get their foot in the door with a 5% down buying a house hack. And that's what this couple did. And fast forward, for the next 2 years, they didn't do anything else. They just kept this rental property. They learned how to manage it. They found a good tenant. They learned how the details of that work and what the mechanics are. They also started studying other real estate investors and meeting people and networking with other people just to grow their knowledge and compound their knowledge. And 2 years later, they did something interesting. They basically did the same thing. They bought a different duplex in another location, not too far away, and then they kept the duplex that they lived in already. So instead of selling it, they decided in this case to rent out the unit they used to live in. So now they have rent coming in from both sides to help them make their mortgage payment. And they're not making any home run cash flow, by the way. They're just getting by. They're just having to, just break even or make a little bit of cash flow, but it's barely making it. And they're able to control this asset, this property that hopefully over time will grow. And so now they bought a second property because they saved up their money money over those 2 years, and they do the same kind of thing. For the next year, they patiently, rent their property out, learn how things are working. And remember I said they started networking and learning and watching more YouTube videos. Well, they learned some other strategies as well. And because they learn more, they're able to think outside the box. They're able to become more experts in finding good deals. And so they find some houses. In this case, they go about 30 minutes away, I believe, a little bit farther outside from Oakland to a place called Vallejo. And I know this area because a student of mine who lived in Oakland, who had a very similar situation to this, went and bought a couple houses that were small, like 1,000 square foot houses in Vallejo, rented them out. It's still expensive, right? These are not going to be like home run cash flow deals like you're going to find in other parts of the country, but he was able to get long-term mortgages on them, make bigger down payments. But he used a strategy that he learned called the BRRRR strategy, where instead of just paying retail price and buying a really nice fixer-up turnkey kind of rental property, he bought a fixer-upper property. This couple did, and they're able to buy it at a lower price. So let's say it's like an $800,000 property. They buy it for maybe $550 and put $50,000 to $60,000 into it, and then they were able to refinance it and pull out a big chunk of their money that they put up front. That's what the BRRRR strategy is all about. And if you hadn't heard of that, I've got some videos on that. There's also books on that. If you look on Bigger Pockets, the book on the BRRRR strategy by David Green's out there. The point is they learned how to do this, and they were able to buy 2 more rental properties and really accelerate their growth in year 3. All right, so let's keep fast forwarding. I know I'm kind of skipping over a lot of details, but I want to show you the big picture plan of what this couple and what you might be able to do as well. So they have their original house hack duplex. They're living in house hack number 2. They bought 2 more rental properties that they're holding and kind of just, making a little bit of money, but not a lot. So they've got these properties. They're building wealth. They decide in year 5, you know what? We're kind of done with the house hack thing. We've done it for 5 years. We've paid our dues. We're just going to move into our long-term kind of dream house. It's a good location. It's in a school district where they really want their kids to go to school, and they just make a down payment. They move into a house. This isn't a house hack. This isn't anything related to investing. This is just where they want to live, but they still have all those other properties. They keep them. House hack 1, house hack 2, and the 2 rentals. So they have a total of 4 properties, and then let's see what they do from there now that they're living in their new home. And so what they do is they just hold on for another 5 years. And again, doesn't seem sexy, not that exciting. They don't do any more transactions. For the next 5 years, they just let the market grow. They're patient and they let things happen. But in year 10, they decide, you know what? We've got a lot of equity. Our properties, the original house hacks we bought, the rental properties we bought, these have all grown in value a good bit. And really that was the whole point of this strategy, by the way. This is more of a growth market strategy where you're not going to make a ton of cash flow year 1, but you're buying in a location where the supply is really limited, but there's still a lot of demand for people to live there. That's the key component of what they're trying to do here. But by doing that, by year 10, their properties that they own are now worth about $2.6 million together. And they decide to make a big pivot. They're going to take the equity they have, and I call this harvesting your equity. They're going to harvest that equity, which is not making a whole lot of cash flow still, even though the rents have gone up a little bit. They have a lot more equity than they do cash flow in their properties. So they decide to do something where they sell their properties in California and buy properties in another part of the country. So they sell them for $2.6 million, and they're patient with this, strategic about this. Maybe they don't do it all at once. They do it over, several months or over a year. They have to pay sales costs. They have to pay real estate commissions, closing costs, things like that. They also have to pay off their mortgages, which I'm just going to say is just over $1 million, $1,025,000. But the key here is they have almost $1.4 million in equity to use that they can go buy something else with. That's the key. That's the reason they've done this over the last 10 years. They've built $1.4 million in equity from the $80,000 they started with, using leverage, using quality rental properties in a growing market. So what do they do next? They use a technique called a 1031 tax-free exchange. And they do the key of this whole strategy is that you can buy more properties, basically replacement properties. You can go from the properties you own in California, you sell them. And as long as you follow the rules, which means you have to identify and buy some new properties within a set period of time, 180 days is the amount of time you have to buy them. You have 45 days to identify some new properties, but they can use the equity, the $1.4 million in equity, and not pay any taxes on that when they sell it, and then buy new properties. And what they did is they went to Greensboro, North Carolina, where they had some family and they knew some people and they had some relationships. They've been studying this market for a while, and they bought 50 apartment units, which were kind of spread out over some small multifamily properties. And they put 30% down to buy these apartment units in Greensboro, North Carolina. So let me show you what this looks like after this big pivot they did of harvesting their $1.4 million in equity, investing in these more cash flow centric properties. So they bought a 12-unit building, another 12-unit building, a 10-unit, and then 4 fourplexes for a total of 50 units. Hopefully I did my math there right. And the total rent on these properties was about $48,000. That's how much is collected every single month. The key though is how much do you net after all your expenses? Because you have taxes, you have insurance, you have management, you have maintenance, you have capital expenses, you have to replace roofs, things like that. And so after that's all said and done, they have just under $29,000 left every month to make their mortgage payment. So $29,000 minus about a $19,300 mortgage. And this is a key component. When they bought these properties and they invested their $1.4 million as down payments on these properties, they got long-term mortgages, some 10-year loans, some 30-year loans, but they're able to get these long-term mortgages, which are going to be fixed for a good period of time. And they can make these $19,000 payments and actually collect some cash flow. And so the difference between $28,830 and their $19,300 is just over $9,500 per month, $9,500 or $114,000 per year. All right, so I want to pause here and think about what they've done and the journey they've taken. Of course, there's all sorts of details that could be different in every person's story, but they started with the amount of money they had, $80,000, using a strategy that used a lot of leverage. They used an owner-occupant loan to get into some house hacks, to get into a duplex, which was in a good location. They moved in. It wasn't a cash flow crazy property, but they moved in. They learned the trade. 2 years later, they did the same thing. They now have 4 units or 2 buildings. And then a year later, they buy a couple more properties. The point of that was accumulation. I call that the builder or the wealth building phase, where you grow your equity. You try to turn a little bit of money into a lot of money. And then they harvested that equity that had grown, and they then turn that into cash flow. And that's the key. If you have wealth, it's not always easy to do, but you can turn that wealth into cash flow. And so they went from like more equity-centric growth properties into more cash flow properties in a market in North Carolina. And now they have $114,000. What do they do with their life now? So if they were making, they're making $300,000 at their jobs, if they're kind of tired of that, or maybe one of them wants to quit their job and stay home with the kids now, or do something different, or they just want to take a mini retirement and travel a little bit. This $114,000 is real. It's money that comes into their bank account that they can use to pay their bills, that they can use to do whatever they want to do. And that's the kind of the motto of my channel, Do What Matters, is that solving the real estate problem, solving the money problem is about giving you options for your life. And that's what cash flow does. And that's what building systems and operations in real estate business does. It's not completely passive. It's passive enough that you can do whatever you want to do. They have to manage their manager. They got to pay some bills here and there, but they can do this remotely. I have done this living in Spain, living in other countries. They don't have to be on site. They can build a team there, but they can still make $114,000 per year. And this is one method, one story of how they could do that. You also might be interested, though, in what does the wealth look like? I mentioned that they had $1.4 million. So when they started off with these house hack duplexes and these California rental properties, they had some equity in those, but they sold them. And now they have value in these other buildings, these apartment buildings. So each of those is worth, the 12 units might be worth $1.1 million, 10 units, $950,000, each of the fourplexes, $380,000. But they now have buildings worth $4.7 million. They have debt of $3.3 million over a 15-year period. So they have $1.4 million that used to be in California, and those rental properties is now in North Carolina and these other properties. But this is real wealth. And over time, as these properties get worth more and more, as they pay their loan down, that $1.4 million will grow bigger and bigger. And so they've become millionaires by starting with this one little duplex in the home that they lived in, renting that out, and they've grown that into a much bigger empire with more properties that they can manage or have managed for them, and they can collect cash flow and do whatever they want to do. Real quick, if you'd like personal help from me to achieve financial freedom with rentals, a lot like this couple in this example, then go to coachcarson.com/mastery. This is my private community of intermediate and advanced rental investors. Every week I do one-on-one coaching. We have small accountability groups. You get all of my live training and my courses, my systems, my processes that I use in my rental business. So if you do join, reach out to me, and really soon we'll be having a one-on-one conversation so I can start helping you. Now that you've heard the case study, the story of the couple in Oakland, I want to turn it back to you and talk about some tips on how you can actually achieve financial freedom, even if you're starting in a higher price market. And I want to begin with a framework, a 3-step framework that's really important to understand. I learned this originally from someone named Pete Fortunato. He's a teacher, longtime investor from Florida. And he always taught that there's 3 phases to your rental investing journey. And I have found that understanding what phase you're in is really important. So I want to describe those really quickly. And the goal for you is just to pick out which one do you think you're in right now. The 3 phases are starter, wealth builder, and he called it an ender phase. Number 3, I didn't actually like ender as much. I call it the harvester phase, where you're harvesting your equity. Another mentor of mine, John Schaub, calls this the spender phase, where you actually spend your money. And the first step, the starter phase, you know you're in there. This is like the beginning of the journey of the couple. When they had the $80,000, the whole goal is just to buy the first deal, maybe 1 or 2 deals. And you're going to learn so much on those first 2 deals. But the important part is not to worry about hitting home runs and building a bunch of wealth yet. You really just need to get in the game. Whatever you can do to safely get in the game so you can start learning, so you can start making progress. That's all it's about. This is the baby steps of real estate investing. So step number 1, if you're there, focus on that beginning part of the journey that I talked about. If you're in the builder phase, this is the longest phase of being a rental investor. So if it takes you 10 to 15 years to achieve financial freedom, in the big scheme of things, that's pretty short, but that's a decade or more of your life. This is where most of it's going to be spending. This is like the grind of the climb up the mountain. And you're really just turning that $80,000 into $1 million. You're trying to grow that as much as you can. You're trying to get a good return on investment. And this is the intermediate or advanced steps of real estate investing. This is where you learn all those strategies like the BRRRR strategy and seller financing and managing your properties well and trying to, grow your capital, grow your wealth as much as possible. That's what the builder phase is all about. The harvester phase, the third phase, I don't think is talked about enough in the rental investing world. That's why I'm trying to talk about it more on this podcast and YouTube channel. The whole goal here is just to finish the race. And it's a very different strategy than the builder phase. A lot of people think about return on investment and make as much money as you can. But in the harvester phase, it's more about having low risk investments. You don't want to get all the way to the top of the mountain and then slide back down and lose a bunch of money. That's like the worst thing that could happen. So you want to start reducing risk. This is where I always often talk on my channel about paying off debt and reducing your debt and simplifying things. It's because it's lower risk. It's also because it's lower hassle. Like the whole goal here is not just to pile up a bunch of money like Scrooge McDuck back in that old cartoon and swim around in your money. The point is to have time and flexibility and trade the money and the wealth you have for flexibility so you can do what matters. So you can contribute to your family, to your community, to travel, to do things that matter to you. So you need low risk, you need low hassle, so you have a lot more time. And then you just need to learn how to enjoy it. And that sounds kind of funny, but a lot of A-type people who have the ability to build this much wealth over a long period of time have a hard time letting go and enjoying life and doing things that they wanted to do in the first place. So kind of a different type problem when you get to the harvester phase. So those are the 3 phases. Kind of figure out which one you're in. And then I would recommend you focus on these 5 steps to apply what the couple did in this case study. Number 1, just focus on buying 1 quality rental property per year. Now, it's easy to kind of listen to stories and say, oh man, so-and-so bought 10 properties in 1 year and they're only 22 years old. And I feel horrible about myself because I'm 50 and I haven't done this yet. You know what? Just focus on 1. That's all you need to do. If you just buy 1 property a year for the next 10 years, you'll be way ahead of the curve. You'll be building wealth. You'll be growing things. You'll have a lot of wealth to work with. Just do 1 house a year. That's achievable. That's manageable. You can do that. But the second thing is it's not just about buying properties. It's also about building management systems and a team. So if you want to hire a property manager, then that is a big important part of your management infrastructure. If you self-manage them, you still need to have a team like contractors, handymen, heating and air technician, people like that. And your tenants. The tenants are part of your team. If you have 10 single family houses, your tenants are your number 1 important relationship, and treating them well and building a good long-term relationship with them so they stay and take care of your property. It's really important. So all that's step number 2, being a good property manager, a good owner of rental properties. Then step number 3 is just to hold on. This is a buy and hold business. This is patience. Like I fast forwarded through their whole story of 10 years really quickly in like 10 minutes, but this is a multi-year thing. And the hardest part for a lot of us, myself included, is just being patient, not doing anything. You don't have to buy and sell and do all these things. The good things in rental properties happen over time. If you've bought a good property, if you get a long-term loan, if you get some good tenants in there, then it's just all about letting the market happen as it will. It's going to go up, it's going to go down, but over the long run in the right locations, our bet is it's going to get better and the rents are going to go up and the price is going to go up. And then you can move into the harvester phase and do something different. And that's step number 4, harvest your equity. And there's a lot of different ideas here. I wrote a lot about this in my book, The Small and Mighty Investor. I have whole chapters on this. But in short, there's a couple ways you can harvest your equity. One is you can do like this couple did in this example. You can sell your properties and then harvest your equity, that $1.4 million they had in those properties in California, to go buy other properties that are more cash flow centric. So they basically put their equity from one market into equity in another market or another set of properties. It's kind of turning over your equity through selling. And it was efficient because they did it with a tax-free exchange. That's the main technique that they used in this example was an exchange. But there's other ways to do this. I talk about in other videos, paying off debt, using like a rental debt snowball. That's a way to reduce the amount of debt you have, increase the cash flow. And in certain situations, that makes sense. In this case, that wasn't exactly the best move, I thought, for that couple. But there's lots of different ways to harvest your equity. The point is, you got to make a pivot. And what worked for you before, you might need to change up in step number 4. Then step number 5, enjoy your freedom. That's really what this is about. The motto again at my channel is do what matters, because the real estate business is fun and the tools of real estate investing are fun to learn. They're very useful, but ultimately it's about your why. Like, why are you doing this? Do you want to go travel and live abroad? Do you want to spend more time with your kids and coach their basketball team? Do you want to spend more time with your parents who are aging and it'd be nice to spend more time with them? Do you want to start a nonprofit? Like, doing what matters, enjoying your time here on earth. That's really what it's about. And doing it now, doing it later, that's what real estate investing is really ultimately all about. So the big takeaway from this episode that I hope you get is that if you live in an area where real estate prices are high, there's still hope. There is a plan. There's a way that you can use rental properties to build wealth and to eventually achieve financial freedom in a relatively short period of time. You got to shift your approach a little bit, use different strategies, maybe use some different timing, but there is a way to do it. And I hope this details of this plan, and of course there's variations of this plan, be something you can use and rely on. But there's one big detail that I sort of glossed over throughout this journey of this couple and the properties they bought was the details of the properties themselves. Like, how do they actually analyze them? How do they run the numbers? How do they buy them? So if you're interested in the mechanics of that, the details of the actual deals that I talked about in this episode, the next video is going to be very helpful. It's actually talking about high cost markets again, but how do you actually double your money using and buying these properties? How do you run the numbers? How do you use a spreadsheet to do that? So if you want to get in the weeds of buying properties, just like I talked about in this episode, then go to the next episode. I'll have a thumbnail above me here that you can click on if you're watching on YouTube, or if you're listening on the podcast or watching on YouTube, you can also click on the link in the podcast or the YouTube description below. I'll see you in the next video.